So picture this. You're sitting there staring at your screen, and out of nowhere, a sudden red candle drops. I mean, it just violently slices right through your support line.
Oh, that is the worst feeling.
Right. You've just lost, say, $1,000 in an instant. And in the next 3 seconds, your heart rate absolutely spikes. Your breathing gets really shallow.
Yeah, your body is fully reactive.
Exactly. And blood actually begins to drain away from the logical planning centers of your brain. And before you even consciously know what you're doing, before you've assessed the chart or reviewed your strategy, your finger is already clicking buy to get that money back.
It's pure reflex at that point.
Totally, because we like to think that when we make financial decisions, we're these purely logical creatures. We analyze the spreadsheet, we weigh the risk, and we act with this cold precision. But the reality is just so much more chaotic.
It's completely chaotic.
Yeah.
Because the ultimate decision maker in that specific moment isn't your intellect at all.
Right, it's your biology.
Yes. When you're operating in a really high-stakes environment, that pristine logic you think you rely on is just routinely hijacked. It's hijacked by your heart rate, your breathing, and this tiny, ancient cluster of neurons deep inside your brain. We are basically navigating modern financial complexities using evolutionary hardware that was designed for physical survival.
Which is wild to think about. Welcome to this deep dive, everyone. Today, we are completely tearing down the illusion of the rational decision maker. We're pulling together an incredible cross-section of research for you.
Some really fascinating stuff in here.
Yeah, ranging from cutting-edge primate neurobiology and psychophysiological studies of investment bank traders over in London to behavioral finance data from the Indonesian retail market. And of course, the hard-learned psychology of professional traders.
It's a really comprehensive stack of sources.
It is. And our mission today is to map out the exact intersection of emotion regulation, psychological biases, and true financial expertise. We're going to figure out exactly how our brains and bodies betray us when the pressure is on.
And more importantly, how to build the actual systems to take that control back.
Exactly. Because whether you are, actively day trading or just managing a long-term retirement portfolio, or honestly even making high-stakes career choices, you are running this ancient software.
You really are. And until you understand the mechanics of that software, until you know how your brain literally, physically processes risk, you're flying blind.
Yeah.
The goal here isn't to diagnose a weakness necessarily, it's to reveal a mechanism. Because if we can see the machinery of decision-making, we can actually learn to operate it rather than just be operated by it.
I love that framing. So let's start at the absolute biological foundation. Before we can even talk about stock charts or market volatility, we need to talk about, of all things, macaques.
Yes, the monkeys.
Right. There's this absolutely fascinating neurobiology study by researchers at the German Primate Center and the University of Oxford, and they wanted to see how the brain processes risk and reward. But not theoretically, right? At the microscopic cellular level.
Yeah, they were looking specifically at the amygdala.
Which we hear a lot about.
We do. And for decades, the popular understanding of the amygdala has been, honestly, incredibly one-dimensional. It's almost always described as the brain's panic button.
Right. The fear center. The thing that triggers fight or flight when you see a snake in the grass.
Exactly. But neuroscientists have started to realize that this structure is just far more sophisticated than that. It's not just a dumb alarm bell. It's an incredibly complex economic calculator.
And to prove this, they set up this amazing experiment. They trained rhesus monkeys to sit in front of a touchscreen, and they gave them a very primate-specific incentive, which was fruit juice.
Always highly motivating.
Naturally. So through trial and error, the monkeys learned to associate specific visual shapes on the screen with different combinations of that juice reward.
Right, and those visual cues were designed to represent two very distinct variables. The first variable was the probability of actually receiving the juice.
So the chance of getting it.
Exactly. And the second was the magnitude, like how much juice they would actually get if they won. So a blue triangle might mean a really high probability of a small reward.
Okay.
While a red square might mean a super low probability of a massive reward.
Got it. And while the monkeys are making these choices on the screen, actively weighing these options, the researchers are doing something kind of incredible. They're using these hair-thin microelectrodes to record the electrical activity of individual single neurons inside the monkey's amygdalas.
They are literally listening to the calculator work in real time, which is just mind-blowing.
It is. And the discoveries from those microelectrodes fundamentally change how we have to view risk assessment.
Yeah, they found that these individual neurons actually process information sequentially. They don't just fire off some generalized signal of excitement or fear.
Right.
First, a specific set of neurons reacts exclusively to the probability of the reward. They literally measure the chance of the event happening. And then, just a tiny fraction of a second later, the neurons react to the magnitude of the reward.
It's so cool. It's exactly like an ancient microscopic abacus deep in the temporal lobe. You can almost picture it, rapidly sliding beads back and forth.
That's a great way to visualize it.
Like it calculates what is the chance of getting the fruit slide and what is the size of the fruit slide.
Yeah.
It's evaluating uncertainty and payoff completely dynamically.
And that concept of dynamic integration is the real key here. The cells are taking two completely abstract pieces of information, likelihood and size, and basically multiplying them together to generate a single value signal.
Wow.
And crucially, this is how the brain naturally defines risk. In the biological context, risk is simply the uncertainty surrounding the magnitude of a potential reward. The amygdala evaluates that uncertainty and generates a physical signal that drives the animal's choice.
And the sources mentioned that some of these neurons are even more specialized, right? Like they process pure probability, completely divorced from whatever visual shape happens to be on the screen.
Yes, it's a pure mathematical extraction happening in one of the most primitive areas of the brain.
Which really highlights just how foundational probability calculation is to basic survival. I mean, every single day, your brain is doing this exact math.
Right. Evolutionarily, our ancestors were constantly having to estimate the likelihood of finding food against the risk of, say, encountering a predator. Today, you might be estimating the probability of a client signing a contract or a stock hitting a certain price target.
Right. The context is totally different.
Completely different. But the biological hardware doing the calculation, that sequential processing in the amygdala, is exactly the same.
Which brings up a massive, glaring contradiction. If our amygdala is this perfectly evolved, dynamic calculator, if we possess this cellular abacus that's literally hardwired to weigh probability and magnitude, why do we make such catastrophic, irrational mistakes with our money?
It's the ultimate question, right?
Yeah, I mean, if the math is literally built into our neurons, why aren't we flawlessly logical when the pressure is on?
Well, it's because the modern financial ecosystem is an environment that our biological calculator was just never designed to navigate. The sheer volume of incoming data, the abstract nature of digital numbers flashing on a screen, the extreme speed of the markets, it just completely overwhelms the system.
The abacus basically gets jammed.
Exactly. We are pushing evolutionary hardware way beyond its operational limits.
And when that system overloads, it seems to default to these incredibly rigid psychological biases. The math gets totally skewed by survival mechanisms that suddenly don't apply to modern finance at all.
Yeah, and we see this play out constantly with the two most destructive forces in decision-making: loss aversion and the fear of missing out.
So let's examine loss aversion first. This is basically the cornerstone of behavioral finance, originally mapped out by Kahneman and Tversky in their development of prospect theory.
Right, a massively important theory.
Yeah. And classical economic theory used to assume that human beings were rational utility maximizers. Like, the old assumption was that a dollar gained and a dollar lost carried the exact same emotional weight.
But prospect theory proved that assumption is wildly false. The core insight there is that we don't evaluate our financial lives based on our total overall wealth. We evaluate everything in terms of changes, gains, and losses relative to a specific reference point.
And usually that reference point is just the price we paid for an asset.
Exactly. And the asymmetry in how we process those changes is profound. We are significantly more sensitive to losses than we are to equivalent gains. The researchers actually quantified this sensitivity with a parameter they call lambda.
And empirical studies generally place lambda at roughly 2, right?
Exactly.
I want to translate that math into a relatable feeling for everyone listening, because the equations don't really capture the reality of the experience.
Okay.
So imagine you're walking down the street and you find a crisp, new $100 bill on the sidewalk. You get this huge rush of dopamine. You feel lucky. You feel happy.
It's a great day.
Right. But now, imagine you walk back to your car and you find a $100 parking ticket tucked under the wiper blade. Mathematically, your net worth is exactly the same as when you woke up. You are at a perfect break-even.
Sure.
But emotionally, the intense anger and frustration of that parking ticket completely eclipses the joy of finding the money earlier.
Oh, without a doubt. And that is lambda in action. It takes roughly twice as much joy to cancel out the pain of a loss. The amygdala heavily weights the negative outcome, because in our evolutionary past, a loss was just far more consequential than a gain.
Yeah, that makes sense. Finding an extra bush of berries meant you were slightly more comfortable for a day.
But losing your only food supply meant death. So we are biologically wired to be hyper-defensive against anything categorized as a loss.
And in the financial markets, this hyper-defensiveness creates a massive behavioral trap known as the disposition effect. It completely inverts rational strategy.
It really does. The disposition effect describes this overwhelming tendency for investors to sell winning assets far too early while holding on to losing assets for far too long.
So backward.
Completely.
Yeah.
If you buy a stock and it goes up, you enter what they call the domain of gains. And prospect theory demonstrates that in the domain of gains, humans become highly risk-averse.
You see green on the screen, and instantly you just become terrified that the market is going to take it away. You aren't analyzing the fundamentals of the company anymore. You're just trying to relieve your own anxiety.
Right, you want the certainty.
So you sell prematurely just to lock in that tiny profit and feel safe. Nobody ever went broke taking a profit is the rationalization we constantly use to justify our own fear.
Yeah, we've all heard that one. But the real danger happens when the asset drops in price, because now you're in the domain of losses. And this is where prospect theory reveals something really counterintuitive. In the domain of losses, we actually become deeply risk-seeking.
Oh, wow. Why is that?
Because selling the losing stock means realizing the loss. It transitions the loss from a theoretical screen value to a permanent, unchangeable reality.
And the brain just refuses to accept that pain.
Exactly. So instead of taking a small, manageable loss, you hold on to the dropping asset. You are basically taking a massive, uncalculated gamble that the price will bounce back, purely to avoid the psychological sting of admitting defeat.
You're holding a decaying asset solely because your amygdala is trying to protect you from the emotional parking ticket.
That's exactly it. It is the biological calculator actively working against the mathematical reality of the market. And the crazy part is that's just the defensive side of our biases.
Right. Then there's the offensive side, the mechanism that aggressively drives us into terrible positions to begin with, and that is the fear of missing out, FOMO.
Yes.
If loss aversion is the brake pedal that makes you hesitate and hold on to bad trades, FOMO is the gas pedal that sends you careening forward without even looking.
It's so dangerous.
We have some incredibly revealing research on this from the Indonesian capital market, focusing heavily on retail investors. And the data paints this vivid picture of how modern technology has completely weaponized our social instincts.
Yeah, the context in Indonesia really mirrors a global phenomenon. Over the last few years, there's been this massive influx of retail investors, largely driven by zero-commission trading apps and those highly accessible digital platforms. The barrier to entry has essentially been erased.
Which is great in theory.
In theory, yes. But this accessibility, when you combine it with the sheer velocity of information on social media, has created a truly toxic environment for rational analysis.
The researchers actually observed that investors were completely abandoning fundamental analysis, like ignoring earnings reports, macroeconomics, all of it. Instead, they were just chasing whatever asset was trending online.
It's pure herding behavior. And the paper dissects this using social cognitive theory.
Which means what, exactly?
Well, this theory emphasizes that human beings learn primarily by observing and imitating the behaviors of others within their social environment. So when you scroll through social media and see an influencer or even just a peer posting a screenshot of a massive return on a specific stock or crypto token, it triggers a very ancient survival mechanism.
Oh, I see. It's like the digital equivalent of seeing your tribe suddenly sprint toward a new food source.
Precisely. You don't stop to calculate the nutritional density of the food. Your
Yeah.
brain just screams, if I don't run with them, I'm going to be the only one left starving.
The social exclusion feels like a literal physical threat.
It does. And that threat response is amplified exponentially by algorithmic curation, which relies heavily on something called the availability heuristic.
Okay, let's unpack that. That's a cognitive bias where we judge the probability of an event based entirely on how easily we can recall a recent example of it, right?
Yes, exactly. And social media algorithms are perfectly designed to exploit the availability heuristic. They only surface highly engaging viral content, so you are just bombarded with success stories. You see endless posts of people making life-changing money overnight.
But what you never see are the silent thousands who quietly lost their life savings on the exact same trade.
Never. And because the success stories are so heavily prioritized in your feed, your brain drastically overestimates the mathematical probability of success. Your internal calculator is being fed heavily skewed data.
So the perceived risk drops to practically zero, and the perceived magnitude of reward just skyrockets.
Exactly, and the result is devastating. The Indonesian study highlights that this cycle causes retail investors to buy assets at the absolute top of the market. They buy when the social chatter is the loudest, which is, ironically, exactly when the asset is most overvalued.
And when the inevitable correction happens, the FOMO instantly flips into panic and they sell at the bottom.
Yep, driven entirely by the anxiety of the crowd rather than the actual value of the asset.
The researchers also noted how the design of the trading platforms themselves exacerbates the problem, right? Like the gamification.
Oh, absolutely. The bright colors, the confetti animations when you make a trade, the seamless one-click buying, all of it reduces the psychological friction of parting with capital. It completely detaches the user from the reality of the risk they're taking.
Okay, I have to push back here for a second, though, because there is a glaring behavioral contradiction that I see all the time in the market.
Okay, what is it?
If loss aversion is truly that powerful, if we are twice as sensitive to the pain of losing, why do I constantly see traders doubling down on losing positions? Like, why do people average down by buying more of a stock that is completely tanking? It seems like they are actively seeking out more loss, which completely violates the idea that we're hyper-defensive.
That is such a crucial observation, and it brings us to one of the most fascinating defense mechanisms the human mind actually employs. Doubling down on a loser isn't a violation of loss aversion at all. It's actually a desperate, convoluted attempt to manipulate it.
Really? How so?
To understand the mechanics of this, we have to look at the concept of cognitive dissonance.
Okay, cognitive dissonance being the intense mental friction you experience when you hold two contradictory beliefs at the exact same time.
Yes. So imagine the internal state of a trader who just executed a position. Belief number one is, I am a smart, capable analyst, and I made a highly calculated decision to buy this asset.
Right.
But then the market opens, the asset plummets, and the screen is flashing red. That gives them belief number two. The market is telling me my decision was completely wrong, and I am actively losing money.
Holding both of those thoughts simultaneously has got to be psychologically agonizing. Your ego and the objective reality of the screen are just at war.
And the human brain will do almost anything to resolve that dissonance and alleviate the psychological pain. The truly rational action would be to accept reality, admit the mistake, cut the loss, and protect whatever capital is left.
But as we know, loss aversion makes accepting that reality way too painful.
Right. So the brain searches for an alternative route to resolve the conflict.
It changes the narrative. It manufactures a totally new belief to bridge the gap.
Yes. It manufactures the narrative by averaging down.
Yeah.
The trader buys more shares of the declining asset at the new, lower price. Mechanically, sure, this lowers their average cost basis for the entire position, but psychologically, the trick is much deeper.
What are they telling themselves?
The trader tells themselves, I wasn't actually wrong about the asset. My timing was just slightly off. The market is actually giving me a gift right now. Now I'm getting a massive discount, and as soon as the price bounces back just a little bit, I will be at break even or even in profit.
Wow, that is incredible. So doubling down isn't about taking a calculated risk at all. It is a psychological anesthetic.
Beautifully put, yes.
You are literally paying more money into the market to delay the emotional pain of admitting you were wrong today. You're buying the illusion that the original belief is still valid.
Exactly. You are purchasing a temporary resolution to cognitive dissonance. And as the research points out, this profoundly increases your actual risk exposure. You're pouring more and more capital into an asset that the market is actively rejecting. You abandon your risk parameters entirely just to protect your ego in the short term.
Which means we aren't even talking about a subtle cognitive bias anymore. We are talking about a full system failure. When the paralyzing fear of loss, the manic energy of FOMO, and the reality-bending defense mechanism of cognitive dissonance all crash into the sheer volatility of a live market, it triggers a highly destructive physiological state.
In psychological terms, it's called an emotional hijacking. But in the trading community, it's universally known as revenge trading.
Right.
This is the terminal stage of unregulated bias. It's what happens when you take a significant loss, and instead of processing it, your biology just refuses to let it go.
There's this fantastic breakdown of revenge trading from ACY Securities, and I love it because it completely strips away the moral judgment. They don't frame it as a lack of willpower or discipline, they frame it purely as neurochemistry.
Which is so much more helpful.
So what actually happens in the brain the exact moment a sudden loss occurs?
Well, it starts with a catastrophic drop in dopamine. Dopamine is our primary reward neurotransmitter. It's the chemical that makes us feel secure, motivated, validated. When a trader takes an unexpected hit, dopamine levels plummet instantly.
And the brain experiences this sudden withdrawal not just as disappointment, right, but as literal physical pain.
Literal pain.
Huh.
And the brain's overriding imperative is always to avoid pain. It craves immediate relief. It wants that dopamine restored right now, at any cost.
So what does the amygdala do?
The amygdala detects this severe drop in dopamine as a massive existential threat. It sounds the biological alarm and initiates the amygdala hijack. The sympathetic nervous system floods the bloodstream with adrenaline and cortisol. The heart rate accelerates, respiration becomes rapid and shallow. Your body literally prepares for physical combat.
So if the body is preparing for physical combat, what is happening to all the complex logical processing power? If the amygdala is consuming all the energy, I imagine the prefrontal cortex, the part of the brain that handles risk management and long-term planning, just completely goes offline.
That is precisely what happens. Blood flow is quite literally diverted away from the prefrontal cortex and routed toward the motor cortex and the deep survival centers of the brain.
Wow.
The logical centers are completely bypassed. The trader is no longer capable of executing a nuanced strategy. They are in a state of pure cognitive tunnel vision. The only objective the brain recognizes is fighting the market to win the dopamine back.
You can practically deduce the behavioral symptoms just from knowing that the prefrontal cortex is offline. I mean, if you lose your ability to plan, the very first thing you're going to do is abandon your strategy entirely. You're going to see instant reentry.
Oh, absolutely.
A trader gets stopped out of a position, and within seconds, they are back in the market. They haven't reassessed the trend, they haven't checked the volume, they just smash the buy button because taking the time to actually analyze would mean sitting with the pain of the dopamine crash.
Action feels like a cure for the anxiety. And because the logical assessment of risk is totally offline, they inevitably increase their position size. If they were risking $100 on the last trade, they'll risk $500 on the next one, desperately trying to erase the previous failure in a single massive swing.
Mark Douglas, who's a pioneer in trading psychology, describes this dynamic so beautifully. He talks about the mental discomfort of risk. Because the market is an environment of absolute 100% uncertainty, the brain interprets every single tick of the chart as a potential physical threat.
Douglas conceptualizes the trader's mental state as standing on a very narrow balance beam. On the left side of the beam is the fear of loss. If you let that fear dominate, you lean too far left. You hesitate, you suffer from analysis paralysis, you miss valid entry signals, and you exit winning trades prematurely just to feel safe.
And on the right side of the beam is FOMO and overconfidence. If you lean that way, you rush entries, you chase price spikes, and you completely ignore your risk parameters.
Right, and the professional is constantly, subtly adjusting their weight to stay centered on the beam. Revenge trading is what happens when the trader falls off the beam entirely and just crashes to the floor.
It really reminds me of the behavioral loop in those incredibly punishing video games like Elden Ring.
A perfect example.
Right. You're fighting a difficult boss, you have a carefully thought out strategy, but you make a tiny mistake and the boss defeats you. The rational response is to put the controller down, take a deep breath, review what went wrong, and adjust your tactics.
But what does the hijacked brain actually do?
You instantly respawn. You sprint back into the boss arena, abandoning your shield, abandoning your timing, and you just aggressively mash the attack buttons. You want revenge. And because you are fighting recklessly, the boss destroys you even faster, which deepens the dopamine crash, makes you angrier, and the cycle just repeats until your character is completely out of resources.
The market is exactly like the ultimate boss fight, with one crucial difference. The market has absolutely no emotion. It doesn't care that you're angry. It will mechanically absorb your capital every single time you rush back in without a regulated plan.
Which raises a really profound question about the nature of expertise. If our natural emotional responses are this destructive, if our biology actively drives us toward financial ruin, is the ultimate goal of a professional simply to turn those emotions off? Do we need to become cold, calculating robots?
That is the single most common misconception in high-stakes performance. People assume the goal is the suppression of emotion. But suppression is not only exhausting, it is biologically impossible to maintain under extreme pressure.
Okay, so if not suppression, then what?
The goal of the expert is not suppression, it is regulation. And what makes this deep dive so fascinating is that we don't have to just rely on psychological theory to prove this. We can actually measure this regulation physically in the real-time bodily functions of professional traders.
Yes. This is where we cross the line from theory to hard, undeniable biological data. The study by Fenton Creevy and his colleagues is an absolute landmark because they didn't just give a survey to retail traders. They went into the dealing room of an actual investment bank in London and wired professional traders up to medical equipment while they worked.
They wanted to capture the physiological reality of financial decision-making in real time during live market hours. They attached ECG sensors, electrocardiograms to the traders to monitor their cardiac activity at a sampling rate of 512 hertz.
That is taking a measurement over 500 times per second.
It's incredibly precise. And they paired that with 3-axis accelerometers to track the physical movement of the traders' bodies. They needed to ensure that if a trader's heart rate spiked, it was because of the mental stress of the market, not just because they, stood up to grab a cup of coffee.
Right. They were isolating the pure physiological response to financial risk.
Exactly. And the specific metric they were extracting from all this massive data is called high-frequency heart rate variability, or HF-HRV. To really understand why this metric is the holy grail of emotion regulation, we have to look briefly at the architecture of the autonomic nervous system.
Okay, the autonomic system being the underlying software that runs our unconscious bodily functions, like heart rate, digestion, respiration.
Yes, the autonomic system is basically divided into 2 primary branches that are constantly playing tug-of-war. The first is the sympathetic nervous system, or the SNS. Think of this as the body's gas pedal. It's responsible for the fight-or-flight response.
Got it.
When it activates, it accelerates the heart rate, dilates the pupils, and mobilizes energy.
So this is the system that completely takes over during an amygdala hijack. It's the gas pedal literally flooring it during a revenge trade.
Precisely. And the opposing branch is the parasympathetic nervous system, or the PNS. Think of this as the body's brake pedal. It governs the rest and digest functions. When the brake is applied, the heart rate slows down, blood pressure drops, and the body returns to a state of calm homeostasis.
So effective emotion regulation isn't about cutting the brake lines or removing the gas pedal entirely. It's about the dynamic interplay between the two. You need the gas pedal to react swiftly to a market event, but you need the brake pedal to immediately sculpt and control that reaction so it doesn't spiral into full-blown panic.
And that continuous tug-of-war between the gas and the brake is what actually creates heart rate variability. Your heart does not beat like a perfectly steady metronome. The millisecond time intervals between consecutive beats are constantly fluctuating based on which system is dominant in that exact moment.
So how does the high-frequency aspect fit into all this? Why isolate that specific band of the ECG data?
Because the high-frequency band, specifically the frequencies between 0.15 and 0.40 hertz, corresponds directly to the natural rhythm of human respiration. This measurement captures a biological phenomenon known as respiratory sinus arrhythmia.
Okay, and what does that tell us?
It's a direct window into the activity of the vagus nerve, which is the primary superhighway of the parasympathetic nervous system.
Wait, let me make sure I'm fully conceptualizing this. You're saying the vagus nerve isn't just a passive monitor, it's actively pulling the brakes on the heart rate in rhythm with our breathing.
Yes. Every time you inhale, the vagus nerve temporarily releases its grip. The brake is lifted, and your heart rate subtly speeds up to circulate oxygenated blood. But every time you exhale, the vagus nerve re-engages. It physically applies the brake, and your heart rate slows down. HF-HRV measures the strength and flexibility of that braking system.
So a high HF-HRV means your parasympathetic nervous system is incredibly strong and responsive. It means your body is actively and successfully applying the brakes, preventing the sympathetic nervous system from hijacking your prefrontal cortex. It's literally the physical measurement of keeping your cool.
Exactly. It demonstrates high autonomic flexibility. The body is experiencing the stress of the market, but the biological braking system is so robust that the stress never crosses the threshold into panic.
So the researchers take this incredible physiological data and they compare it against the reality of the market. And the findings are just a revelation. The first thing they correlated the HF-HRV against was market volatility, specifically tracking the VIX, which is often referred to as the fear gauge.
Right. And they found a significant inverse relationship. As market volatility spiked, As the charts became more chaotic and the price swings more violent, the trader's HF-HRV dropped significantly.
Which means that when the market goes crazy, even elite investment bank traders physically lose their ability to apply the brakes. The sheer chaos of the environment degrades the capacity of their vagus nerve to regulate their heart rate. They physically slip closer to that amygdala hijack.
It proves that absolutely no one is immune to the biological impact of the market. The stress is universally degrading to our regulatory systems. But the second finding of the study is what truly redefines our understanding of financial expertise.
This part is amazing. The researchers correlated the daily average HF-HRV with the trader's years of professional experience, and they found a staggering positive correlation. The more experienced the trader, the higher their baseline HF-HRV while actively trading. Their biological braking system was fundamentally stronger than the novices.
And the timeline they attach to this adaptation is just extraordinary. The data show that a one standard deviation difference in HF-HRV is associated with approximately 15 years of trading experience.
15 years. I just want to pause and let that timeline settle for you. It takes a decade and a half of daily exposure to the markets to physically rewire how your central nervous system responds to financial risk.
It's not a quick fix.
No, expertise isn't just about reading more books on technical analysis or memorizing complex option strategies. True, elite expertise is a literal biological adaptation. Over thousands of hours of screen time, thousands of wins, and thousands of agonizing losses, the expert's vagus nerve has hypertrophied like a muscle.
That's exactly what it is.
Their body has physically evolved to process the trauma of financial loss without allowing the amygdala to shut down the prefrontal cortex.
It's the ultimate manifestation of neuroplasticity. The body adapts to the specific demands of its environment. And this biological adaptation allows the expert to do something the novice simply cannot do. Differentiate between the noise of their own panic and the genuine signal of their experience.
And the researchers clarify this by making a vital distinction between incidental emotions and integral emotions, which is crucial for understanding why we shouldn't strive to become emotionless robots. What is the difference there?
Incidental emotions are feelings that are completely unrelated to the decision at hand, but they bleed over and corrupt your judgment. For example, if you have a terrible commute in the morning, or an argument with your spouse, you arrive at your desk agitated. That anger is incidental. It has nothing to do with the stock chart, but it might cause you to trade aggressively out of frustration. It is pure emotional noise.
Right, you're just projecting a completely unrelated stressor onto the market.
Exactly. But integral emotions are entirely different. Integral emotions are the subtle, subjective feelings that arise directly from the decision task itself, generated by your vast reservoir of past experience. This is what we commonly call a gut feeling, or intuition.
Okay, so it's not just a guess.
No, it's your brain's pattern recognition software, unconsciously synthesizing thousands of past charts and generating an emotional warning signal before your conscious, logical mind can even articulate the math.
Oh, it's exactly like a veteran firefighter. They walk into a burning building and suddenly they feel this overwhelming, inexplicable urge to evacuate their team right before the floor collapses.
Yeah.
They didn't stop to mathematically calculate the structural integrity of the timber. Their brain recognized subtle, subliminal cues of danger, the sound of the fire, the color of the smoke, and translated that massive data set into an immediate emotional imperative.
That is a perfect analogy. Intuition is just hyper-accelerated pattern recognition delivered as a feeling. The researchers argue that a novice with low HF-HRV, poor physiological regulation, is constantly overwhelmed by incidental emotions. They are drowning in the noise of market volatility and their own fear. They literally can't hear their intuition. But the expert with high HF-HRV, or the trader with 15 years of vagal tone development, can effortlessly apply the brakes to the incidental noise.
Yeah.
They remain physically calm enough to actually hear and trust the valuable integral emotions their experience has built.
That biological capacity is practically a superpower. But this leads to a massive, very practical dilemma.
Right.
If I am sitting at my desk right now preparing to manage my portfolio, and I do not have 15 years of professional investment banking experience, what do I do? If my vagus nerve hasn't undergone that physical adaptation, how can I possibly survive the market? How do I artificially simulate that biological brake pedal today?
That is where the transition from physiological observation to practical, structured strategy becomes vital. If you do not possess the internal biological hardware to regulate your autonomic nervous system autonomously,
Yeah.
you must build external behavioral protocols to force the regulation manually.
You have to create systems that bypass your amygdala entirely. Which brings us to the actionable core of this deep dive. Practical strategies for regaining control. We are looking for the emergency brakes. And the ACY security source provides one of the most effective protocols I've seen for neutralizing the amygdala hijack. They call it the 3-minute reset rule.
It is a brilliant, structured ritual designed to manually shift your nervous system from sympathetic dominance back to parasympathetic control the moment you feel the urge to revenge trade.
Let's really break down the mechanics of this because every single step is engineered to exploit the biology we just discussed. Step 1 takes exactly 15 seconds. You have just taken a brutal loss. You feel the heat rising in your chest. The dopamine has crashed. Step 1 requires you to verbally name the emotion aloud. You sit at your desk and you literally say, "I feel incredibly frustrated. I am experiencing an amygdala trigger right now."
Now, to a novice, talking to yourself after a loss feels absurd. But neurologically, it is a highly targeted intervention. It relies on a psychological concept called effect labeling.
How does that work?
When you are triggered, your amygdala is burning massive amounts of metabolic energy. But the moment you force yourself to articulate that emotion in concrete language, you are forcibly recruiting the language processing centers of the brain, which are located in the prefrontal cortex.
Oh, you are manually diverting the blood flow.
Yes. Brain imaging studies have repeatedly shown that when subjects put their negative feelings into words, the electrical activity in the amygdala measurably decreases, while the activity in the right ventrolateral prefrontal cortex increases. You are literally pulling the energy away from the panic center and forcing the logic center to boot back up.
That is amazing. So that first step breaks the initial trance. Step 2 takes 30 seconds. You must stand up and physically remove yourself from the screen. No charts on your phone, no checking the price action. You physically walk into another room.
And this step addresses the physical loop of the fight-or-flight response. The sympathetic nervous system has primed your body for physical action. It wants to fight the threat. If you remain seated, staring at the flashing red numbers, the visual stimulus continues to pour into the amygdala, constantly re-triggering the alarm.
Makes sense.
By moving your physical body into a neutral environment, you signal to your nervous system that the immediate existential threat has been removed.
Okay. And then in step 3, we directly hack the biology we learned from those London traders. This step takes 90 seconds. You execute the 4x4 box breath. This is a technique famously utilized by Navy SEALs, first responders, and elite athletes. You inhale deeply for 4 seconds, you hold that breath for 4 seconds, you exhale slowly for 4 seconds, and you hold empty for 4 seconds. You just repeat the cycle.
And remember, this is not just some relaxation technique. It is a physiological override.
Yeah.
By deliberately slowing your respiration, and particularly by controlling that extended exhale, you are reaching under the hood of your autonomic nervous system and manually pressing the parasympathetic brake pedal. You are artificially stimulating the vagus nerve.
You are forcing your HF-HRV to spike.
Exactly. The slow, rhythmic respiration forcibly overrides the sympathetic nervous system's command to panic. The heart rate is compelled to slow down. Within those 90 seconds, your physiology shifts fundamentally from a reactive survival state back to a baseline, rational state.
Only once that biological equilibrium is restored do you move to step 4. You sit back down, you look at the chart, and before you are allowed to touch the mouse, you ask yourself one ultimate filtering question. Would I take this exact trade if I were already up plus 2R for the day?
2R meaning twice your initial defined risk. So the question basically asks, if you were having a fantastic, highly profitable day and your dopamine levels were completely saturated, would this specific market setup still look mathematically viable?
It is the ultimate lie detector test for the brain. Because if the honest answer is no, if you wouldn't touch that setup on a good day, then you know with absolute certainty that the only reason you want to take it right now is to alleviate the pain of your previous loss. You are purely revenge trading.
And if the answer is no, the protocol dictates you walk away entirely. The ACY guide establishes a brilliant, inflexible rule. If I lose 2 trades back to back, I shut down the platform for the day. 0 exceptions.
That's tough to do, though.
It is, but this kind of rigid boundary slowly rewires the brain's reward pathways. It teaches the nervous system that discipline and capital preservation are the ultimate forms of control, not frantic action.
I really love the idea of manually overriding the system, but the protocols only work if the underlying mindset is correct, and this requires adopting a mental framework that Mark Douglas champions, the necessity of thinking in probabilities.
Thinking in probabilities is the antidote to the fundamental cause of our emotional pain in the markets, which is our desperate expectation of certainty. Douglas argues that the mental discomfort we experience isn't caused by the market itself, but by our rigid insistence that we know what will happen next. We take a position expecting to win. When we don't, we interpret it as a personal failure or some malicious betrayal by the market.
But the reality is the market is a continuous distribution of random variables. You do not control the outcome of any single individual trade. The only thing you control is your execution of the process.
Right. If you have spent months developing a statistical edge, say, a strategy that wins 60% of the time, you still have absolutely no way of knowing which 60 out of the next 100 trades will be the winners and which 40 will be the losers.
Huh?
The distribution of those wins and losses is completely random.
Which means any single individual loss is mathematically meaningless. It carries zero weight regarding your overall success. It is simply a data point. Douglas calls it the statistical cost of doing business. It's exactly how a casino operates.
Oh, that's a great comparison.
Right. The casino manager doesn't panic and experience an amygdala hijack when a player hits blackjack. They don't suffer from loss aversion on a single hand.
They don't panic because they know they possess a statistical edge over a sample size of 10,000 hands. Thinking in probabilities requires shifting your entire perspective. You move away from the micro focus of, I absolutely must win this specific trade right now, to the macro focus of, I am going to execute my edge flawlessly over the next 100 trades.
And when a trader truly internalizes that probabilistic reality, the fear of loss simply evaporates. The amygdala doesn't sound the alarm because a single loss is no longer perceived as a threat to survival.
And the ultimate physical tool for executing that edge flawlessly, regardless of your emotional state, is the trading checklist. We have a really detailed breakdown from IG on how professionals construct this architecture. It's divided into 3 distinct phases: pre-trade, during the trade, and post-trade.
Okay, let's go through them.
The pre-trade checklist forces cognitive engagement before the adrenaline ever hits the system. You must explicitly define your motivation. You must review the macroeconomic calendar to ensure you aren't walking into a high-volatility news event blind. You must calculate a strict risk-reward ratio and analyze multiple timeframes to confirm the trend.
You are forcing the prefrontal cortex to do the heavy lifting while it is still fully functional. And then during the trade, the checklist introduces the most powerful tool against cognitive dissonance, the hard stop-loss order.
We all understand the mechanical function of a stop-loss. It's an automated order logged with the broker to sell the asset immediately if the price drops to a predetermined level. But the psychological function is what truly matters here.
Right. Neurologically, a hard stop-loss is simply the act of outsourcing your prefrontal cortex to a server. You are making the rational decision to cut the loss while your logic is online and locking it in so that your panicked amygdala cannot negotiate with you later. When the price drops, the computer executes the trade. You are denied the opportunity to average down. You are denied the opportunity to rationalize holding a loser. The cognitive dissonance is bypassed entirely.
And finally, the post-trade checklist. This is where long-term expertise is truly forged. The IG framework insists that you do not merely record the financial profit or loss. You must rigorously journal the subjective emotions you experienced during the life of the trade.
Oh, I like that. When did you feel the grip of FOMO? When did you hesitate out of loss aversion? By documenting the emotional arc, you begin to recognize the specific psychological patterns of your own mind. You drag your unconscious biases out into the light, which is the absolute prerequisite for regulating them.
Now, when we outline these deeply structured systems, the 3-minute breathing rules, the inflexible stop losses, the exhaustive checklist, there is a natural resistance that arises. A listener might push back and say, this level of strict rigidity sounds suffocating. Doesn't all this mechanical structure destroy the creativity and the profound gut-feeling intuition we were just praising the 15-year experts for developing?
I understand that resistance perfectly. It feels like we are advocating for becoming a robot. How do we reconcile the strict rigidity of a checklist with the flowing intuition of a master trader?
We reconcile it by understanding a fundamental paradox of human performance. The rigidity of the process is exactly what creates the freedom of the mind.
Okay, let's explore that deeply. How does building a psychological cage actually set you free?
Consider the cognitive load on a trader who operates without a strict checklist. From the moment they open a position, their brain is consumed by a chaotic wrestling match with their own biology. They are constantly battling the fear of loss, the greed of FOMO, and the mental gymnastics of cognitive dissonance. Every tick of the chart requires a new agonizing decision. Their prefrontal cortex is completely exhausted just trying to survive the emotional turbulence.
The internal noise is deafening.
Exactly. But when you completely outsource the risk management to a rigid checklist and automated hard stops, you remove the burden of those survival decisions from your immediate consciousness. You don't have to decide when to exit. The plan already decided for you. By strictly controlling the parameters of the process, you liberate your mental bandwidth.
Your mind actually becomes quiet.
Your mind becomes incredibly quiet, and it is only within that quiet, structured environment that you can actually observe the market objectively. You can finally hear the subtle, sophisticated signals of your integral emotions, the true intuition of pattern recognition, because it's no longer being drowned out by the static of your own biological panic.
It is the difference between flailing desperately in the open ocean and swimming in an Olympic pool. The lane lines in the pool restrict your lateral movement. They are entirely rigid. But that restriction is exactly what allows you to put your head down and swim forward with maximum power and efficiency, without fear of colliding with anything. The structure is what allows the expertise to emerge.
That is the essence of mastery. You don't defeat the biology, you build the structure that channels it.
So, to synthesize this massive journey we've taken today, whether you are scalping the markets on a 5-minute chart, allocating capital for a 10-year horizon, or just trying to navigate the high-stakes decisions of your career, you must recognize the biological hardware you are operating with. You are running the exact same ancient evolutionary software as those macaques in the German primate center, weighing probability and reward on a cellular abacus.
Your amygdala is constantly, sequentially calculating risk. And your deep-seated biases, the asymmetrical pain of loss aversion, the social terror of FOMO, and the reality-denying comfort of cognitive dissonance, are constantly attempting to skew that math. They are trying to protect you from short-term emotional pain, often driving you toward long-term catastrophic failure.
But the physiological data from the dealing rooms of London proves that true expertise is possible. We saw it in the 15-year biological evolution of the expert trader's vagus nerve, and we learned that even if we are novices today, even if we don't have a decade of adaptation under our belts, we can use structured tools like effect labeling, box breathing, and rigid checklists to manually apply the brakes. We can engineer our environment to keep our prefrontal cortex online.
The market guarantees uncertainty. We cannot control the chaos of the charts, but we possess the profound ability to engineer our biological and psychological response to that chaos.
Which leaves us with a final, really lingering thought to ponder as we close out this deep dive. We spend countless hours trying to optimize our external strategies. We scour research reports, we backtest financial models, we build faster algorithms, endlessly searching for some hidden edge in the data. But based on everything we have unpacked today, the most crucial algorithm we will ever need to optimize is the one currently running in the space between our own amygdala and our prefrontal cortex. If true financial expertise is ultimately marked by literal physiological changes in how our heart and nervous system handle stress, it raises an incredible question. Could it be that the intense chaos of the financial markets isn't just a brutal arena for making money? Could it actually be the ultimate training ground for human emotional mastery?